Most retirees get handed the same advice. You need three buckets to retire safely: a short term one, a medium term one, and a long term one. And on paper, it's a tidy little system, organized, reassuring. It's probably the most popular retirement income strategy out there right now. But here's my issue with it: that three bucket setup can give you a feeling of safety while quietly dragging down the growth of your portfolio for the entire length of your retirement. So today, I want to make the case for a different framework, and more to the point, show you what the data actually says that can move the needle here, regardless of how many buckets you run. Hi, I'm John Amarillo, president of Securus Financial, and I've spent a long time building retirement income strategies for clients that hold up in real life, not just the ones that look clean on a whiteboard. And I'm about to challenge something almost nobody in the business questions. We'll start with the structural flaw in the typical three-bucket model. Then we'll look at what the research actually shows about how these strategies perform and the part that tends to catch people off guard. And we'll finish with a clear way to figure out which approach actually fits your situation. So why did the three-bucket strategy become the default? Well, first, the logic is genuinely appealing. Bucket 1 holds a year or two of expenses in cash or money markets. Bucket 2 carries another 3 to 7 years in bonds and conservative holdings. And Bucket 3 is everything else, sitting in equities to grow. If the market tanks, you live off Bucket 1 and 2 and leave Bucket 3 alone to recovery. You're never forced to sell stocks at the bottom. You sleep easier. The whole thing feels bulletproof. But there's a cost nobody mentions, and that's the hidden cost of too much cash. That cash in Bucket 1 isn't just sitting there safe and sound. Inflation is eroding it the whole time. Run the numbers. Say you're holding 2 years of expenses in cash. Call it $120,000. At 3% inflation, that's roughly $3,600 of purchasing power gone every year, just evaporating. And honestly, that's a smaller part of the problem. The larger drag is the opportunity cost. Everything that money could have been earning had it been invested. Retirees consistently underestimate the long-term impact of holding excess liquidity, particularly in the early years of retirement when compounding matters most. Stretch out across a 25-year retirement, and the drag from parking too much in cash becomes very real. Now, here's where it genuinely gets interesting. The research on bucket strategies turns up something most people would never expect. This type of bucketing strategy may not actually shield you from sequence of returns risks the way everyone assumes they do. Think it through. Every bucket is drawing from the same underlying portfolio. Refill Bucket 1 from Bucket 2, top off Bucket 2 from Bucket 3. You're still liquidating from the same pool of assets either way. But what the buckets really provide is a psychological burial, not a mathematical one. It feels like protection, but the actual mathematical evidence is considerably more mixed. Behavioral confidence matters, but it shouldn't come at the cost of portfolio efficiency. Now, if you're sitting there wondering whether your own setup is quietly costing you, that's exactly the right instinct. That's the kind of thing we dig into at Securus Financial. If you'd like to see what your real numbers look like, there's a link below to book some time with me. So, what does a smarter two-bucket approach actually look like? It simplifies the machinery and sharpens the purpose of each allocation. Bucket 1, predictable, sustainable income. This bucket isn't just a cash reserve, it's your income engine. It's designed to generate a reliable, predictable stream of income that covers your essential living expenses. Think housing, healthcare, food, utilities. Now, when you were working, what gave you the peace of mind to pay your bills? A paycheck. So why not replicate that familiarity? Think of this as your personal paycheck in retirement, your personal pension. This is funded through investments built for predictable income. Think annuities, dividend and interest generated in fixed income, or other structured income solutions. The goal isn't growth. The goal is certainty. Retirement expert Wade Pfau identifies income certainty as one of the top behavioral drivers of retirement satisfaction. And this bucket is how you deliver it. Moving on to Bucket 2. This is your growth bucket, just like when you were working. When you were working, your income had two components: what you earned today and what you grew for tomorrow. Bucket 2 is the grow for tomorrow piece, a diversified or tactical growth-oriented portfolio built around your risk tolerance and your long-term investing horizon. This is where the compounding happens. This is where inflation gets beat. And because bucket 1 is already handling your income needs, you're not forced to liquidate this portfolio at an inopportune market time. It can do exactly what it is designed to do: grow. So I mentioned only 2 buckets, but does my strategy actually have a third bucket? Yes, it's the emergency bucket. And this bucket is not an investment bucket. It's for emergency reserves, not a lifestyle buffer, not an extra income layer. Emergency money only. Think 3 to 6 months of cash parked somewhere highly liquid, a money market or an FDIC insured bank account. This exists so that if something unexpected happens, like a major medical event, a home repair, or an unforeseen event, you're not touching either of the 2 core buckets. Now, most people can keep this lean, and its only job is to prevent a crisis from becoming a portfolio disruption. You are understandably sacrificing rates of return to have this emergency cushion. I already know the question forming in your head. What if the market craters? It's the first thing everyone asks, so let's actually address it. And I want to be honest with you about 2 different ways advisors answer this. The first approach is the industry standard, diversified buy and hold. You build a broadly allocated portfolio and stay the course through downturns, hoping your diversification holds to your risk tolerance levels and trust that the markets have historically recovered over time. Because bucket 1 is generating income, not just spending down cash, you have a fundamentally different posture than most retirees. Your income doesn't stop because the market dropped, and bucket 2 can actually weather the volatility because you're not pulling from it to pay your grocery bill. The structural advantage is that you've built a system that doesn't require you to sell at the wrong time. Now, the second approach is what we do at Securus Financial, and that involves tactical investment management. Rather than simply holding through volatility, hoping the downturn isn't worse than we planned for, and waiting for a recovery, we actually monitor market conditions and move portions of your portfolio to more defensive positions when conditions warrant it, in an attempt to protect your capital from a significant drawdown. The goal isn't to predict the market, it's simply to have a process that responds to it, so that bucket 2 isn't just structurally protected from forced selling, it's actively managed to reduce the depth of the hole you'd have to climb out of. And bucket 3, your emergency reserve, remains the final backstop so that no short-term crisis forces a reactive decision. Now, no approach eliminates risk entirely, and past performance is no guarantee of future results. But knowing which philosophy is managing your money and why matters far more than most people realize. So what does the research actually show? Well, here's the uncomfortable finding when it comes to the traditional bucket approach. When researchers compare bucket strategies against systemic withdrawal approaches, the bucket count itself doesn't drive outcomes. What does? Flexibility, the willingness to adjust spending when the conditions change. Discipline, a clear rules-based approach to when and how you draw income. And efficiency, keeping as much capital invested and working for you as possible. Now, research from Morningstar's David Blanchett has shown that retirees using structured, rules-based withdrawal strategies compared to the ad hoc spending decisions preserve significantly more portfolio longevity and experience less financial stress over a 20 to 30-year retirement. Now, what's most important to retirees? That peace of mind, not having that stress. So let's do a hypothetical comparison. Take a retiree with $1 million. In the 3-bucket retirement version, they have $100,000 in cash, $300,000 in bonds, and $600,000 in stocks. Versus the modified 3-bucket or the 2-bucket version, you have $400,000 in an income-generating portfolio in bucket 1 and $550,000 in a growth portfolio, bucket 2, along with $50,000 in emergency reserves in that optional bucket 3. In the 2-bucket version, every dollar has a defined purpose and job. And the growth portfolio is larger and mostly unencumbered and free to compound over the full length of the retirement. The income bucket is doing its job, so the growth bucket never has to do double duty. It's merely that future fund money or more powerful inflation hedge. The results depend on markets, timing, your specific situation, the usual caveats. But the structural logic is sound. Less cash drag, more purposeful allocation, more compounding. Now, let me be straight with you, because I don't want this to come across as one-sided. The 3-bucket strategy isn't wrong for everyone. For some people, it genuinely earns its keep. If seeing several years of expenses visibly set aside is what allows you to relax and actually enjoy your retirement, that psychological value is real and well documented. Retirement investment behavior consistently shows that retirees who feel financially secure spend more freely, experience higher satisfaction, and derive greater value from their retirement years. So if a more layered structure is what gives you that security, the cost may be worth it. The key question isn't how many buckets you have, it's whether the structure you've built actually serves you emotionally and mathematically. So here's the real takeaway that I want you to hold on to from all of this. It was never about the number of buckets. What matters is whether you have a system with a clear purpose behind each allocation. One built for bad markets, not just calm ones. A framework with flexibility to adjust as life changes. And the discipline to keep the bulk of your capital working rather than sitting idle out of fear. The best retirement income strategy isn't the one with the most buckets. It's the one that you'll actually follow when markets get ugly. The one that keeps you liquid enough not to panic sell and keeps as much of your portfolio compounding and growing as possible. The retirees who navigate this well aren't the ones with the cleverest structure on paper. They're the ones with a clear plan, the discipline to follow it, and someone in their corner helping them stay steady when everyone else is losing their heads. So what's right for you? Well, what's right for you comes down to your numbers, your income needs, your tolerance for market volatility, and, I'll be honest, your temperament. If you want to work out which version actually makes sense for your situation, I'd be glad to walk you through it. The link is in the description below. See you in the next one.